Hello everyone, and welcome to our global market seminar on commodity markets. We have the great pleasure, this is the first of hosting 24 experts across various business lines to discuss their views on the commodity market, on trends for 2026. Obviously, commodity markets are very much center stage today. They are the key questions surrounding the 2026 outlook. To be honest, maybe this is one way of explaining the foreign policy of Donald Trump, that he wants to be to have the dominancy on energy market. When you think of it, intervention in Venezuela, intervention in Iran, intervention in Nigeria, lots of things are happening these days, maybe that are linked to the energy market, with China leading the way in electrification, probably the first electro state on one side, and the other side, the US is pushing fast and very, very hard on the rest of the energy market. So we're all with this question with the geopolitical landscape is shifting towards a more interventionist US in key energy producing countries, like I've just mentioned, and this is probably going to continue. We see that with Greenland, for instance, a lot to do with rare earth symbol for sure, but as well probably with energy market. Same for China. Is it going to emerge as still a big engine of growth through export, or is it going to switch to a more consumption-led economies? That we're going to have major implication for energy market. We see that China is probably one of the winners of this first leg of the trade war, and one of the key things that China has done is to weaponize and leverage on its rare earth dominancy on that, and we shall see if this is going to be a threat or a leverage that China is going to use again, like it was the case in 2025. For many questions, but clearly probably energy commodities are very much at the center of the geopolitical landscape. So I'll leave it to our two world famous experts on energy within Natixis CIB research, Joel Hancock and Bernard Dada. Thank you very much for joining us.
Thank you, Jeff. Thank you for joining us. We're kicking off with first the macro session. Obviously, the macro topics are one of the biggest drivers for commodities, specifically US rates. We'll be talking about inflation, the US dollar outlook, all of which impact oil, and which might lead us to think or discuss about potential Trump actions given the role of inflation, energy in inflation, the gold, how gold is impacted also by US rates, base metals by also the cost of funding, and currency exchange impacts on commodities as a whole. So joining us from New York is Chris, from Shanghai is Janwei, and Valerie from Paris. Chris, I'm going to kick off with you. Basically, the question, just a generic question, is about if you can give us your concise view on your 2026 US macro across rates, the inflation, and the US dollar.
Thank you, Bernard. The U.S. entered 2026 with pretty solid economic fundamentals, and we do think there are a few tailwinds that are going to come into force this year as well. A lot's been made about the K-shaped economy, but that's more about the outperformance of folks at the upper half of the K than those at the bottom half of the K falling behind. We have seen delinquency rates rise for consumer loans, auto loans, mortgage loans, etc. But they haven't risen to troubling levels, and in aggregate, consumer balance sheets are still in pretty good shape. We have some tax policies that are going to provide some tailwinds for consumers, and they should also help broaden out investment to more traditional CapEx categories, not just tech. So overall, we do expect growth to stay pretty solid at about potential at about 2.1% or so. We do think that there will be a pickup in inflationary pressures towards the back half of 2026, and we do think that ultimately the Fed will be cutting 3 times in the first half of 2026, but be forced to pivot to a more tight policy stance in 2027.
Thank you, Chris. That's very important, obviously, for gold. If that pivot happens, you're talking about solid growth and painting somewhat of a rosy picture, which is fair enough from a macro perspective with all the arguments that you put forward. But there is somewhat some uncertainty from the political spectrum when it comes to expectations about the Fed remaining independent. What's your take on that? And what happens to the markets if that independence is perceived as lost?
Yeah, we are certainly seeing the Fed undergo stress test after stress test, but I do think that ultimately independence is going to reign for the Fed. Now, whoever the new chair turns out to be, they will be a mere 1 vote among 12. And any sort of uncredible policy arguments, I don't think are going to sway the other very serious and sober policymakers at the Fed. I think the real test is going to be the legal case of Governor Lisa Cook and whether or not Trump or any president can fire a Fed governor. Now, the court has indicated that the Fed is special and warrants additional independence, but the outcome of the case is not guaranteed. If the courts do side with Trump and the president has full personnel control at the Fed, then all bets are off and independent and credibility of the Fed will certainly be on the line. But that's not my base case. And I think that the guardrails for the Fed are going to stay in place.
Thank you. And just looking at some of the drivers of last year, when I look at base metals, for instance, they're still being impacted by this tariff uncertainty. We saw some arbitrage taking place. We saw the impact on silver. We've seen previously the impact on gold and currently still on copper. Do you think by 2026 we will have reached peak tariff uncertainty? Is there also the midterm elections also coming in? Can you give us some color on this?
Yeah, I don't think that we've reached peak tariff uncertainty, and that was evidenced by Trump's threatening 10% on EU countries that support Greenland over the weekend. But I do ultimately think that we've seen peak tariff rates. Now, the courts are expected to issue a ruling in the next few weeks, and the expectation is that they rule against Trump and his use of emergency powers to apply tariffs only as he sees fit. Now, of course, there are other means to apply tariffs, and I do think that tariffs will stay a constant threat in Trump's arsenal. But I think, as what we've seen in late 2025, I think he'll be very hesitant to apply new tariffs. There is a shift to the his what he calls the affordability agenda, and I think that's primarily to try to quell inflation in the lead up to elections in the fall in the U.S. So I do think that the election calendar is going to help constrain his policy options when it comes to tariffs.
Thank you. I'm going to move on to China, and obviously China being the world's largest consumer of commodities, some also one of the largest producers of some of the commodities also. Jianwei, what's the outlook, macro outlook, if you can tell us in a few sentences what the Chinese macro outlook is, and if we do need a stimulus or not, what would it look like?
So for China, so you probably have already seen the GDP number for 2025 was quite a good 5%. However, I would like to cast some caution on the reading of the number because the whole economy at the moment is supply driven. As you correctly point out, the market is not only looking at the growth number itself, because in theory, China could increase the supply, but all the demand does not come from the country. So people are looking at the demand. I have to say that the demand situation for China is quite terrible. So you have seen that both consumption and investment are slowing down rapidly towards the year end of 2025. So looking into 2026, I think this could rebound a little bit because I know that the government has lifted some bullets for 2026 because they know they have reached the target, so they don't want to exhaust their bullets. So they will probably do some help for 2026. However, I will still be very cautious on the bet on China's demand and also stimulus because the government is not willing to to unleash demand as they did in 2008 when there was like a 4 trillion. I don't think this is going to happen because the Chinese government, they are now moving on to something that is more important for them, namely technology upgrading and supply and self-sufficiency. So the target of economic development this time is completely different. So I would not think that the stimulus will be as large as the market is expecting for the commodity market.
Thank you, John Wei. You're talking about the government moving towards updating technology, going up the value chain, etc. Where does this leave the real estate market? I mean, from me as myself as a base metals analyst, this is the Chinese real estate market is a considerable source of demand for a lot of base metals.
Never give you the number recently, you will see how bad the real estate market it was for 2025. The situation was that it was already very low in 2024. So many people, including me, were thinking, okay, 2025 will not be so bad because of the base effect. However, the situation turned out to be even worse. In the second half of 2025, we have seen that the new home sales fell by around 10% to 15% year on year, and the home price continue to decline according to the official number by 2% to 33%. But I have some anecdotal evidence that in many cities the price slump may be as big as 10% or even 20%. So the situation is very bad. The property development investment also fell by 15 to 20%. So those topics does not bode well for the metal market. So when it comes to what the Chinese government is going to do, I have to say that the government is not so concerned about the real estate market because it's not the focus of the Chinese policy making for the moment. And they probably will try to stabilize the market, but they will not do as much as supporting the market. The Chinese government has made it very clear that they wanted the real estate market to be only a living market, but not an investment market. So that means that we probably cannot expect the real estate market to expand as quickly as it did before.
Thank you, John Wei. I'll move a little bit. We talk from the macro side of things with our macroeconomists, but I'll move to Valerie, who's has more of a trader's point of view. It's always interesting to mix various views. Valerie, from your side of the business, from your habit as being a trader, how would you position a trading desk for such themes that are presented to you just now in 2026? And also, we'd be very interested to know from your side, what can you see in the market that's already embedded or factored in the market?
So yes, thank you, Bernard. So actually, I can quickly review what happened in 2025 because to a large extent, I think it matters a lot for 2026. So 2025 was a great year for momentum trades in the macro space. Actually, on rate market we had steeper curves, which was the name of the game. On the back of the well-telegraphed continuation of the easing cycle by major central banks and the impact of Dutch pension reform and more generally a repricing of the term premium. The interest rate cut cycles now being priced in like mostly done and over with very little uncertainty about the terminal rates. This triggered in 2025 a sharp move down in interest rate vol, both short-term and long-term. On the FX front, the talk of the market throughout all the year was all about the value of money, the depreciation of fiat currencies, and of course the dollar depreciation in particular. So we witnessed a broad-based dollar weakness. Our index was down a solid 10%, down 4 against renminbi, down 12 against euro. And we witnessed as well a sharp decline of FX volatility. And on Como, of course, while energy prices continue to normalize downwards, we witnessed a relentless bull market on precious metal. Silver more than doubled, gold spike $2,000, and even more importantly, gold actually was the best performing major market for global investors. If you were long gold, you were returning 65% in dollar terms, so outperforming S&P by more than 45%. So all this was a very positive background for risky assets, and especially for European and Asian indices over US ones. So my point is I would argue that these 2025 trends were a continuation of what happened, an acceleration somehow of what happened actually since late 2022. All these trends have started then. Late 2022, when energy prices topped out, TTF was trading above 300, oil was trading around 100. This was the time of inflation fear frenzy when it peaked. And it was also the time where dollar FX hit a cyclical peak on the back of a fast and furious Fed tightening cycle. So at the time, dollar index reversed at around 115 level. Now we are, and started this downtrend, and now we are trading below 100. This was also the time of the beginning of the gold rush, and more generally the precious rush. We were trading at the time 1,600, so 1/3 of where we are trading now. And silver was trading around $20, $20. And this was also the beginning of the massive reversal of interest rate curves, negative slopes, start of an epic 250 basis point bull steepening of the 230s. So volatility at the time also started to get crushed across the board. So why am I elaborating on this long-term trend? Because entering into 2026, the big question is, are we witnessing some rotation out of these momentum trades, or are these a change in trends? So my view is that actually the bulk of these multi-year correlated trends that I just described are done, and the positioning on top of that, well, it's to say the least stretched, so no question about that. So we do think actually we are managing a trading desk on FX, rate, and Como world. We think it's time to, at the very least, to take chips out of the table. Overall, though, I can see further leeway for the continuation of the défiance vis-à-vis the dollar and dollar assets. So I can still see further outperformance out of European and emerging stocks versus US ones. I can see also the resuming of the trend of broad dollar weakness, even though we are tactically in a phase of seemingly of pause for the past 6 months. But I can see the resuming of the broad dollar weakness. We won't be surprised to see a further rally as well on precious metals, even if the price action looks very much like a blow-off price action. So I wouldn't be surprised to have, and we discussed a lot about that, Bernard, but I wouldn't be surprised to have at the very least rotation between the 4,900 and 5,000 level on gold. Silver, I can see, and we will be engaging the market this way, around 110, 120-ish level. I think we'll get some rotation there. So
thank you, Valerie.
It will be an interesting story for this year.
Thanks a lot, everybody, for your time. Very much appreciated, and we'll head to the next session. Thank you.
Hello, everybody, and welcome to our geopolitics section. So geopolitical risk was a key driver for commodity markets in 2025. And just a few weeks into the new year, it seems like the same is going to be in play for 2026. So with Trump's intervention in Venezuela, threatened strikes of Iran, and attempting to purchase Greenland, it really does seem like the geopolitical guardrails are off. Now, one factor which has been quite consistently brought up is the central position of commodities to the narrative surrounding Trump's recent foreign policy moves. And that narrative has been linked to the growing recognition of what we'd call the material deficit of the West. So broadly, the lack of control over some of the key supply chains that underpin our high-tech industries. So AI, for example, and technology and defense. And that is contrasted with China's relative dominance in some of those areas. So I'm delighted to have a very expansive panel here to discuss some of these issues. So we'll start with Chris Hodge, our US macroeconomist. So Chris, a very broad question to start, but in your mind, these moves from Trump, what world order does the US want to create with some of these dynamics?
Yeah, there's a few different foreign policy factions within Trump's White House. You have first the isolationist camp. This is the group that wants government resources to be diverted from messy foreign policy or foreign interventions and reapplied to the forgotten man of America. And I think that's probably best exemplified by Vice President J.D. Vance. Number two, you have a more Reaganite faction that is more in the traditional conservative impulse to help free oppressed peoples from communism. And I think this is best exemplified by Secretary of State Rubio. Third, you have the prioritizers, and they want to focus on containing or combating China's rise at the expense of other regions across the globe. Now, there are elements of all three in Trump's foreign policy, but there's not really a consistent through line for any of them. I think Trump is very comfortable with spheres of influence and would like to combat China's rise, but I don't think either is a very strong underlying goal. I think Trump's foreign policy has been largely transactional, it's been reactive, and it's been based on his bilateral relationship with his counterpart. And I think his foreign policy is less about creating a new world order and more about building his own legacy. And I think that's specifically with acquiring Greenland, or I think simply about exploiting commercial opportunities.
So how much of that do you think is linked to commodities access, as some of the narratives that we've heard over the past few weeks would suggest?
I think that certainly plays into the commercial opportunity aspect of it. I think, also combating the rise of China, that, does appeal to the various strains of foreign policy ideology within his executive branch. So I certainly think that it plays a role, but I think short-term commercial gain is probably more of a driving factor.
So we talked about the the policy strands within the actual establishment, but in terms of the voter base, particularly looking ahead to midterm elections, how does this intervention play with that electorate, especially considering the more kind of, I suppose, isolationist bent of the MAGA movement?
Yeah, overall, foreign policy is far from the top priority for American voters, and especially for Trump's political base. Now, strong displays of the military and foreign policy wins are always going to be popular, and his supporters can always get behind those. Americans want wins, but they want those wins to be costless, and any losses are going to be extremely unpopular. So foreign adventurism is inherently risky because the wins alone aren't going to boost Trump's popularity, but any sort of perceived losses will certainly undercut it.
Perfect. And then final question I think would be the continuity of this shift in US foreign policy beyond Trump, because we can always look to the example of Trump's first term and the more hawkish posture towards China, which was then largely carried forward by the Biden administration. So say we did see a change in the White House following the next election, would we see a dramatic shift away from the new Trump foreign policy by that new administration?
Yeah, it's really a great question. And traditionally, foreign policy and alliances have not changed much from presidential administration to presidential administration. That, of course, changed a lot under Trump when he was first elected in 2016. Now, if a Democrat does win in 2028, they will surely try to mend fences with allies, especially allies in Europe. So a Democratic president would certainly try to get back to business as usual. But how effective can that actually be? Europeans can't and won't forget what's going on right now with Greenland, for example. And there's no guarantee that a similarly inclined president to Trump won't take the reins again in 2032. So I do think there will be a push to normalize alliances, but it's got to be taken with a grain of salt by American allies.
Perfect. Thanks so much for that color, Chris. And obviously we have, the other side of the coin when it comes to this shift in geopolitical posture, and a lot of that is going to be, driven by China. So to discuss that, I'm delighted to have Alicia, our head of Asia research. So really, how, Alicia, do you think China is going to respond to this more assertive US geopolitical posture? Obviously, Venezuela was a major oil supplier to China, particularly off-market barrels, which were secured at discount. Iran as well. So what do you think Beijing's response will be?
Well, I'm not sure Trump realizes, but I don't think there's anything that could of more positive than Trump that could ever happen to China, and that's where we are. That's my first statement. Of course, within that wonderful wave of allies, whether it's Canada or the European Union, getting their way towards China because of Trump, there is, however, of course, uncertainty as to what that might mean. And this brings me to Venezuela, but it could be any other example, to be frank, is that, while the US may push you, and this is Venezuela on its side, China is going to just wait and see, sit there. Say Davos, yeah? What's going to happen is that China is basically bringing only its deputy prime minister. Why? Because they don't want to confront Trump. They don't want to respond to Trump. So when Canada visits, or, we get into this amazing, because for 10 years, Canada and Chinese relations have been horrible for reasons that everybody know, from, direct detainment of two Canadian, it's really hard to see how you can switch. You can if Trump helps you. And that's where we are. So you can see all of these, big gains, even if China does not really speak up. It doesn't need to, because actually, if it does, it would be much worse. Of course, nothing is for free. China had a big free lunch in rogue states. Venezuela is one. We think of Myanmar, Iran, you name it. Some are already, as we speak, moving towards the US sphere. But I don't think that's going to be easy to maintain. In other words, I think the US is getting quick gains, but I'm not sure whether they are sustainable gains. Beyond cheap oil, China does have a lot of interest in Venezuela, whether it's precious metals to a lesser extent critical rare earth and critical raw materials, and that's very hard to change, in my view, unless you are really in Venezuela. You're running Venezuela. I think that would bring us to something that actually some of US ideological advisors or influencers have thought of, which is this new colonialism, yeah, Curtis, others. I mean, it's not impossible, but frankly, I think it's difficult for the US to go all the way there. And in that regard, I think China will continue to creep in, yeah, keep its sphere of interest, maybe with a less of a, you know, in a less obvious way, while gaining the US major alliances, which are probably more important than Venezuela if you think about it. So in that regard, I think, you know, this is a big game for China. I would say maybe to our dismay as Europeans, in the sense that it's a very tricky place to be for Europe. But that's where we are.
So I suppose we could, at the moment, summarize China's view as don't interrupt your opponents when they're making mistakes. Say, for example, like we did see that move from China towards a more, you know, assertive kind of response, particularly around rare earths. What do you think it would take for China to open that front again?
China is assertive when the US hits China directly. So when the US comes with very high tariffs, yeah, China doubles down. It's like a poker game. You hit me, I hit you. But China does not hit when Trump hits or induces somebody else. That's the game. Because by doing that, it behaves like Trump. That's kind of the reading. China wants to show the world that it's not a bully, or at least I'm just using China's word at the UN. So, you know, I'm not making anything up. So that's the game. But if the US hits me, i.e., you mentioned one specific example, that was a response, China's response to two very relevant decisions. But let me give you one for the benefit of time, which was that the US decided to include around 1,000 companies in the entity list, subsidiaries of companies already in the entity list, and China didn't like that. So China responded with a bazooka, export controls on rare earth, which the US could not swallow. So when China responds, they are big responses, but they're directly related to something that the US does towards China. And to finish here, this is exactly why the US does nothing directly anymore towards China. It asks Mexico to increase tariffs of around 50%. It may ask Europe, who knows, you know, but it will not do that directly anymore. If anything, we're going to have two summits this year. The first will be in Beijing in April, and then we have the APEC summit in Shenzhen, I believe. Long story short, the 10% fentanyl tariffs, in my view, that remaining are going to go. And if Europe happens to end up with 10% more because of Greenland, frankly speaking, whatever comparative advantage we thought we had versus China in the US market is gone. So, you know, this is why I think China is playing on directly hardball. Indirectly, let it be, because the US is crashing with these policies and basically, as you said, as you know, shooting on its own, directly on its own, against the US itself. So, you know, China doesn't need to do anything, only when it hits directly. And that's a big response.
Perfect. Thank you, Alicia. So I think what we've outlined here is really a major geoeconomic balancing act that ultimately we all need to adjust to, and particularly, you know, commodity producing, consuming and trading companies have to navigate this new environment. So very happy to have Anne-Marie on the call as well, just to kind of talk us through some of these dynamics. So, you know, we're now in this environment where, you know, access to different markets can be gained and lost very quickly. We've seen that with Venezuela. So how are we seeing commodity players adjusting to this new geoeconomic environment?
The new world order is completely different from the old one. The old one was based on the idea that anyone could have access to any commodity around the globe with the right price. So the allocation was all about price driven, and the market was completely global. What we've seen with Trump, even if it started before, is that now this availability of commodity is no longer guaranteed by price. And more people have been using non-monetary weapons to control access to commodity. So Trump obviously has been using massively the tariff as a threat, and we'll come down to the consequences on the commodity market. But China has been very vocal about, and also implying putting in place some control about rare earth. We're seeing also a lot of resource nationalism, whether it's in DRC or Indonesia, a couple of ban on cobalt or nickel. So we're moving away from this new world order and entering in a new world order where restriction to access is definitely part of the playbook. So the consequences we've seen, and especially we've seen that on our commodity clients, is that it has created a lot of volatility, a lot of uncertainty. Trump is completely unpredictable, and it's been obviously creating a lot of volatility. This volatility obviously has been sometimes very good for traders. That is really the only one to navigate into this difficult, uncertain times. We've seen that on the copper recently. So the threat of tariff has created a gap between the LME and the CME, creating a massive inflows of copper to the US to take advantage of this arbitrage. But we also see that on the copper premium. We've been seeing that when on the aluminium, when Trump wanted to put tariff, so the Canadian on the Canadian aluminium producers. So all those aluminium were going to Europe rather than going to crossing the border to the US. We're also seeing that in another way with the ban that the Chinese had on the rare earths that has triggered massive investment on the West, being extremely concerned about the supply chain security of the critical metals. And maybe one thing we have to keep in mind is that this obviously fragmented market, new playbook, has a huge consequence, obviously, on the traders and creating opportunities, as I mentioned, but also created a very difficult world for investors. So commodity investors are long-term investors. It takes a lot of time to scratch a new, to build a new mine or to develop any commodity assets. It requires billions in investments, and you need some kind of stability. So now obviously we're seeing some price signals with overshooting of precious metal price or copper price. So on the West, this should create the opportunity for more investment into those fields. But what we see that it has much more trigger an M&A appetite, and we've seen the Rio Tinto Glencore transaction being put back on the table. So the question is going to be: is this uncertainty is going to be creating massive investment by increased prices, or should create a standstill where basically nobody wants to invest anything because there's so much uncertainty? And what we've seen on the West, that I think we're still searching exactly how to respond to this new world order, while the Chinese, as Alicia mentioned, keep working on the same playbooks and be very consistent in those investments, continue to basically go everywhere where they can increase the commodity flow and secured as much as they can, commodity bringing back to the homeland, bringing back to China. So that's a little bit the new world order, and it's not just about Trump. It's something that started before Trump, but actually we see things accelerating rather quickly.
Perfect. So really what we're saying here, we're painting a picture of the bifurcated market where access is key. We have spheres of influence and less faith really in the market being able to provide supply, but at the same time, we're not really fully ready yet to commit to the full costs and implications of that new playbook. So that's kind of wrapping up a fascinating session on the geopolitical dynamics within the commodity markets we can expect in 2026. Now, we're definitely going to continue to see these upside price excursions as we settle into this new world order, particularly among commodities where inventory levels are tracking at or below 5-year kind of average levels. So thank you very much for tuning in, and stay connected for our next session. So whilst we'll be exploring key themes for 2026 in our deep dive sessions, what we wanted to do was provide a quick fire commodities outlook to plant our flag in the sand and give our quick views for 2026 across the main commodities in our coverage universe, before then expanding into a more deeper analysis with the individual sessions. So to start out, Bernard, if you could please give us your metals outlook for 2026 across base and precious.
Thank you, Joel. I'll kick off actually with the precious metals section. So from my side, when it comes to gold, I see more of a consolidation phase for 2026. I see prices at around 4,300, 4,400 as an average. Let's look at the reasons. The reasons being, in my view, is that yes, the de-dollarization story continues, probably even somewhat accelerates given the uncertainty, rising uncertainty that's taking place in terms of US geopolitical moves in terms of this redefining of this new world order. So that should, in theory, be beneficial for gold. But what we're also expecting to see is central bank demand to potentially slow down. The reason being is that with prices almost doubling in terms of tonnage, central banks don't have an unlimited firepower when it comes to purchasing gold. So we'd expect in terms of tonnage a slowdown in central bank demand. When it comes also to jewelry consumption, we're seeing a slowdown there. We're seeing a demand destruction that's actually benefiting platinum. And also in terms of rates, we'll probably reach the end of the rate cuts, which is, we know, for gold, and the opportunity cost of holding gold is a big issue. Now, when it comes to silver, I think the risk for silver on the downside, and considering where prices are currently, I think we could potentially see a very sharp drop in silver. The reason being is that, first of all, in terms of industrial demand, we shouldn't forget that around 65% of silver is industrial demand. And actually in China, we're seeing somewhat of a slowdown there when it comes to the consumption. Solar panel demand, Chinese solar panel demand alone, in terms of installing capacity, is 10% of global demand for silver. And China last year reached its 2030 targets of installation of solar panels. So a slowdown we'd expect to see from there. And also silver being much more volatile than gold, and silver being impacted by the tariff wars, Section 232. So a lot of uncertainty there, we think, has been driving the silver prices higher and potential arbitrage. As we reach peak uncertainty for tariffs this year, probably with the Supreme Court ruling on this topic, we'd expect the uncertainty to unravel when it comes to this topic and silver prices to drop. In terms of our copper outlook, so we see copper prices also dropping, prices at around averaging 10,800 to 11,000 for 2026, which is quite generous in historic terms, I would say. It's just that for us, the price of the price of copper currently is being driven by a lot of uncertainty relating to tariffs, a lot of uncertainty as to if the US will expand its tariffs to include all copper products. So some of the arbitrage taking place with the US right now is still open, and we think that is still driving copper prices much higher than where they should be. Another also important point to mention is true that we've seen a lot of stoppages last year with the Grasberg story, and some of the other mines also stopping, but we'd expect them to come back online, doing a restart this year. But also very importantly is Cobre Panama mine coming back at the forefront in our view. Don't forget that this mine produces around 1% of global copper output, which is not negligible when it comes to a market that's in such deficit. We think that the Panamanian government cannot afford to keep this mine shut. We've seen the impact on its GDP. So there is an audit taking place, an independent audit taking place, and after that, the Panamanian government will make up its mind as to the reopening or not of this mine. We'd expect to see a final decision somewhat in the middle of this year. Penultimate point, aluminium. We think that aluminium prices are also much higher than where they should be. Very strong correlation with copper if you look at the curves right now over the past year and a half. There is a ratio, a current ratio of around 4.2, which is deemed as a substitution ratio where it makes financial sense to substitute copper with aluminium, and that could potentially be driving aluminium prices naturally or mechanically higher, even if that's very complicated for consumer to swap the metals. But so we think if copper drops, which is our view, then aluminium prices could come off. Our final point, somewhat of better news, given some of the very bearish views I've been giving on base metals, is our nickel outlook. We see nickel prices averaging around $17,800 to $18,000 a ton this year, mainly on Indonesia wishing to reduce its quotas for mining of this metal. That's about it from me, Joel. I'll hand over for you for the energy sector.
Yeah, sure thing. So for the oil market, we do believe in the oversupply narrative, particularly for Q1 26. We see around 1.8 to 2 million barrels per day of on paper crude builds, but importantly, we do think a large share of that will be in the OECD, and that is going to drive prices lower, assuming, as we do in our base case, that current geopolitical risk and outages at the CPC terminal do ease. But importantly, we do think that the floor for the market is potentially higher than anticipated, and there are three key reasons behind that rationale that we hold. The first one being the OPEC reaction function. The OPEC have been, for many analysts, operating against the cycle, really increasing production when balances on paper seemed oversupplied. However, what we do think is that the group will be reactive when actual OECD builds do arrive in size, which we do expect in Q1. So we do expect an OPEC cut, potentially at the April meeting, which for us will tighten up balances for the second half of 2026. The second point is that we do expect to see strategic SPR purchases by China to continue at a relatively high rate through the year, particularly in the new geopolitical environment that the Trump administration is creating, particularly given the continued build out of these storage sites. The third point is more fundamental, and we do expect to see a weakness in US upstream, which we expect to decline in 2026, led mainly by independent producers. So for an average for 26, we're a bit above the consensus, expecting around $62 per barrel Brent. For European gas, demand creation is the buzzword for us for the year. So we're definitely going to carry out a much lower end March storage number year on year, given the relatively cold weather we've experienced through late December, early January. Forecasts for the same potentially later in January and into February. However, in our base case, we do expect enough gas to be available to refill those stocks. And that is really assuming that key LNG projects that are due to come online do arrive into the market, with the key risk we're highlighting around the Golden Pass startup, also the operational status of LNG Canada is important as well. But in our base case, these projects do occur to schedule, which means that we are able to refill European stocks, as well as then having excess LNG that we'll need to clear into emerging Asian markets. And so there we're looking more at liquids parity being a ceiling for the market as we seek to drive substitution towards spot LNG with liquid switching in the Indian refinery sector, truck sector for China as well, or trucked LNG competition as well. So for us, TTF around 27 euros as an average for Cal 26 is about right. If we do see some slippage on these LNG projects, then that value can rise into the low 30s. So really that's the critical factor for us to watch for the market in 26. And then for carbon, tightening imbalances for EUAs are undeniable, really, when we look at the supply trajectory. However, we would highlight that sustainable gains in this market do require industrial hedging. At the moment, the rally that we've seen through Q1 so far mainly been driven by speculators. And of course, we can see liquidation on macro events, as we saw following Liberation Day, some selling as well following Trump's threats to impose tariffs as European countries have opposed his plan towards Greenland. So we do expect to see some rationalization of these spec positions, which could push carbon prices a bit lower than the early Q1 levels. However, we are still bullish given the fundamental outlook, and we do expect to see a relatively strong industrial bid come into the market, or compliance entity bid, as prices move lower. So therefore, we do see around 85 euros per tonne as an average for 2026. So with that, we can conclude our kind of brief introduction to our views on the key commodity sectors that we cover for 26. And please stay connected for a deeper dive involving ourselves and members from various business lines. Hello, everybody, and welcome to our session focusing on global gas prices, with a particular focus on the European market. So supply loss following Russia's invasion of Ukraine in 2022 has really defined the global gas market. But looking forwards, we now have a significant wave of new LNG capacity, which is going to trigger the transition to a new market regime. But timing that transition to that new regime and what that regime looks like remains elusive. So to help shed some light into this issue, we have our gas traders on the call with us today. So we have Raphael Deveau on our European gas trader here in London, Richard Lysander in New York, and then we also have the pleasure to be joined by Amarek Chavot in the ENTR team to talk about some of the implications of this new market regime on some LNG projects going forwards. So what's our kind of research view on European gas prices for 2026 and 27? So from a macro level, we do still believe in an oversupplied market for 2026, particularly over summer 26. But a lot is going to depend on the startup schedules of new capacity, LNG capacity, I should say. So in particular for the summer values, we're looking at Golden Pass. We're looking at the performance of the two LNG Canada trains and the Corpus Christi train startup schedule as well. Darwin's restart will also be important, as well as Pluto in Australia as well. We can define price formation in this new regime as demand creation. So this contrasts to the demand destruction regime we saw following the loss of Russian pipeline gas from Europe's balance. So this means TTF will be trading at the bottom of the coal to gas switching range to try to burn as much gas in the power sector as possible, and then also trying to incentivize switching from liquids towards gas as well, really trading below liquids parity levels. So LPG, fuel oil, very important references. Try to turn on as much flexible demand in Asia as possible. So particularly looking at industrial demand in India, so the refinery sector, particularly important, and then in China as well, with the price differential of spot JKM against trucked LNG inland again will be an important reference point to try to absorb as much of the global LNG surplus as possible. So what that means for us is a TTF price over summer in the mid-20s, when we look on a euro per megawatt hour basis. And we still hold that view, despite the fact we have seen some volatility through mid-January. So very cold weather towards the end of 25 and in the first week of 2026. And that's led to heightened sensitivity around future cold weather events through the remainder of winter 25. So February and March in particular. Now it's clear we're going to exit towards the bottom of the kind of recent range for end March carryout and significantly below winter or March 25 levels. So, despite that kind of drawdown in stocks and that lower carryout year-on-year RAV, do we still believe in that oversupplied market for 2026, or do we see this oversupply regime delayed another year?
Well, we've had a very interesting start of the year, coming from December, where we got to the lows pushed by funds positioning, getting to record shorts. We always said that this winter was fairly unknown given the low inventory we started at. So that was always going to be a wild card and quite weather dependent, which it is actually now happening. However, what we can already observe is that actually the supply coming into Europe through all different channels, should it be North Sea, Africa, LNG specifically, is very strong. The LNG arrival and boat arrivals into Europe, which I am tracking quite actively at the moment, is strong specifically for Northwest Europe and potentially making close to record or a new record for the month of January. Given the widening spreads in between TTF and JKM in one part, and TTF and Henry Hub since mid-December, there are currently all the incentives to deliver very strongly in that part. The LNG feed gas in the US is also very strong and goes unabating. So I think it is already there. We obviously have a large part, some significant consumption and storage withdrawals, which need to be compensated. Yeah, for the time being, it is absorbed, well absorbed. I think in the past 2 weeks also, we had a lot of positioning being closed out on the funds. So that geopolitics and so on have triggered loads of short covering. However, the supply is really there.
Yep. So we can probably summarize to say a lot of that volatility is spec driven, and even though we have seen incredible rally really over in a very short tenor in kind of mid-January, remains within the kind of fundamental constraints of the market when we look at front month TTF within the coal to gas switching channel, where it's not as if we're in the Q1 25 pricing dynamic where some of that storage target sensitivity upside triggered pricing kind of diverging kind of above those fundamental levels. So again, we probably say that the LNG is there right now, and we're looking relatively comfortable for summer 26 if those new starts do come online. But really that is going to be the key question to watch going forwards, particularly given some of the histories around Golden Pass, for example, and that slippage. So definitely going to have a keen eye on that as the kind of market driver in the coming months. And that leads me nicely over to the US market. So obviously, you know, with the development of the significant LNG wave and the new wave of projects, exposure to you know, US upstream is growing for a huge number of players. But it's not only LNG feed gas, which is the you know, price insensitive demand source within the US with the AI thematic, also driving kind of strong demand projections on a go-forward basis. The question for Richard sitting in New York is, you know, where do we see the balancing point for US gas prices, Henry Hub, with these two, you know, competing, you know, price insensitive demand sources, which are surely going to grow significantly in the next few years?
Yes, so looking at the US market today, we obviously have a huge move here in the front end of the curve of expected colder weather to come, and which most probably set the tone for 2026 if it materializes. But yes, you're absolutely right. Golden Pass here is expected to come online in Q1 with their first train, and their second train to follow shortly thereafter. Corpus Christi expansion, as well as Canaport also this summer. Those are all kind of priced into the market already. What we are seeing right now is the Cal 26, the balance of Cal 26 at $350 per MMBTU. Now, you are right also with in the terms of another demand source, which is the power. PGM is expected power demand to go up about 4% this year, but it's not only one source here. So gas will compete with not only with renewables, but also with coal. Coal started to make inroads last year. A little surprising for some, but it's very price sensitive here. And with the current administration, there are actually been plans that have been taken off the retirement list. So we don't expect any more coal plants to retire. But we also saw a big increase in renewable production, even in areas in the northeast of the United States. So not only do we compete with coal and renewables, with gas around 350, I think we're in a good shape still to capture a lot of the demand from the power sector. But if we move up higher than here, then I think coal is going to make bigger inroads, and renewable obviously going to take what's there in any case. When it comes to the supply side, is also that we are at record levels of production, and we expect production to continue to increase, to grow this year. And I would say that any times of type of slip ups when it comes to the LNG or coal even taking a bigger piece of the pie than expected, I think that is the cap, and I think that's around $4 on the upside at the moment. We can also see on the downside, producer responses in terms of shutting production in, but I don't think that will happen until we are around the 275 or below level. I think that is the price level where I do think we're going to see some, not shut-ins, that's the wrong word. I don't think we will see connectivity of wells that have already been drilled, and also investment into new wells. And I do think we can still see the shoulder months get down to 275. We were only there last week, or even below 275. But what I'm saying here, we only see a producer response. It need to be a prolonged period of gas prices around that level. And looking at Cal 27 and Cal 28, I do think we are in the middle of we are right now around the 350 to 360 to 370 in Cal 27 and Cal 28. I do think we will see a producer response, meaning they will increase production if we go above $4 here. I think what we saw here with the selling off, I think a lot of producers are looking at it. If we get up to 410, 415 on Cal 27, I do think we're going to see increased production going forward, new investments, etc. And on the downside, and I do not think we were going to challenge the downside here, but I think we have a $3 floor here as well when it comes to the price level. So we are kind of right in the middle right now, but I think when it comes to Cal 26, because we're going to see such a significant increase of production, I do think there is more fear to the downside than the upside here at the moment. But obviously we don't see that today with a significant upswing here due to cold weather, but just in general. Yeah.
Thanks for that, Richard. So I think it's really interesting that you point out the almost re-emergence of coal capacity as a potential source of flex, particularly in 2026. If we do see those higher Henry Hub values, and would you say then that your view is that at $4 per MMBTU, we can see sufficient dry gas production in marginal basins like the Haynesville, for example?
I do think so. At that level, absolutely. I think that actually a good point. Haynesville is one of those locations which is kind of tied in also to LNG exports, but it is in such a location that it's really important as a swing producer, but it's not cheap in Haynesville. I do think we need the $3.75 plus $4 to actually increase production there. You're absolutely right.
Perfect. Thank you, Richard. So clearly then the growth of US LNG exports is leading to kind of more players in this market having multiple exposures to multiple gas hubs. So interesting bit of news from earlier this month, Mitsubishi kind of taking an upstream position in the Haynesville to hedge some of their feed gas requirements for their LNG offtake. But what's clear is that we will be entering into what we call a lower price regime for global gas prices, so TTF and JKM in Europe and Asia, as this LNG is seeking a home effectively. And then we can say that if we do see really robust domestic demand in the US, both from the power side, but also from LNG feed gas, ultimately we are going to see a floor price for Henry Hub around about this kind of like $3.80 to $4 range per MMBTU that Richard was mentioning. And so what that means for us is that 2022 onwards, we've seen very, very rich Henry Hub TTF spreads, but these are clearly going to narrow going forwards. Now, a lot of new LNG capacity was sanctioned, at least supported by those wide spreads, and clearly we do see them narrowing going forwards. So we saw Lake Charles cancelled, for example, given that kind of less attractive macro regime from the global gas basis. So really I'd like to bring Americ into the conversation here and ask about which projects do we think will get the green light, or what's going to characterize or define some of the projects which will be successful in this new regime going forwards.
Yeah, another very good point. I think well, when it comes to financing all these projects, well, first we have a very specific lending policy, so we're really focusing on the expansion projects, and I think we're probably looking at the time scale is really different of the discussion we've had until now. Looking at what's going on over the past 2 weeks, the next few months during winter period, what's going on, what will the market in 2026, 2027. When it comes to getting into financing this project on the debt side, we're really looking at a longer period of time, clearly on the markets, and then we have to be selective on the project base. The first element I would say to be, in terms of what else the project will be focusing on is clearly that these are projects where we have long-term offtake contracts being secured. So that's really the first point. There is very few or very limited merchant risk being considered. If it's the case, anyway, it's within the boundaries of being covered through a DSCR. So yeah, that's really the first and foremost key point. Long-term offtake contract being secured and with investment grade counterparts. That's really important as well on the offtake side. Of course, the projects that will go through, as we know, there are many projects nearing FID in the pipe. Not all will go to conclusion, as we've seen with Lake Charles, or it might be reviewed in the future, but for now it's suspended. And then one of the key criteria is when you look at the economics of this project, so very much driven by the EPC contracting strategy and cost. We clearly see an inflation on the EPC side and the construction side. And on that, we are focusing on the projects offering the best economics that is mostly benefiting from brownfield cost. So clearly expansion project is one, so you can leverage on several existing infrastructures in terms of feedstock pipeline access, land access, existing burrs, CO2 storage, natural gas storage. So clearly you can benefit from this when it's an expansion, and many projects you will see, Black Mines, Calcasieu Pass from Venture Global or other are really looking at expanding existing capacity. And the other trend we are seeing is reconversion of existing sites. So, previous LNG import sites are being reconverted to liquefaction for exports. So again, here benefiting from brownfield cost, which really makes a difference on this. Yeah. So these projects are reliant on the longer term. So we can expect to have potentially lower demand, so utilization rates that will probably be a bit more volatile than in the past. That's for sure. But we also expect the market on the longer term to readjust itself. I mean, by this I mean that having lower gas prices or LNG prices is also creating demand, because you're getting more competitive versus oil consumption for some final uses, so competition with oil products. So at some point in time, you will re-increase demand with lower price. So it's not instantaneous, but it is a mitigant to reprice. And even I would say in terms of contracting strategy, even LNG developers are ready probably to have a slightly lower fees initially in their contracting strategy to be able to make sure they are de-risking the startup of their project and make sure they are leveraging all existing and planned capacity.
Yeah, thank you for that comprehensive answer, Aymeric. And one point I think that you made, which is really very well made, was really a lot of these projects are going to have requirement for investment grade offtakes or offtakers. So, I mean, have you noticed a change in the types of company that are maintaining that appetite for offtake from some of these nascent projects?
Not really. I mean, still, again, strong focus on the investment grade counterparts. Probably a bit more diversified than it used to be, but it's more driven by the geographical destination. So I think Europe remains really strong first and foremost, and APAC. So we see diversification in terms of names of counterparts, but in terms of quality, still very high on the trend. And probably the same nature of takers. Also, potentially, what we see is, as Richard mentioned, I mean, there's still very strong gas feedstock position. A very strong natural gas production capacity in the US, and we've also seen projects being developed, so liquefaction project being developed at the boundaries, also in Mexico, so at the frontier. So with the gas being gathered from the southern states to have liquefaction capacity in Mexico, but being sourced with US gas.
Perfect. Thank you very much. So that kind of takes us to the end of our gas session, and we can really summarize by saying the new kind of gas regime is very close to being realized, and really we know what that looks like. It looks like demand creation being the main focus for demand side markets. So we're looking at liquid switching, we're looking at maximum priced in gas generation against coal in some of the key demand markets. And from the producer side in the US, we're looking at dry gas production being priced in at the margin in the Haynesville. So we're looking at maybe mid-20s on a euro per megawatt hour basis for TTF, around $3.80 to $4 minimum BTU on Henry Hub in the US in order to kind of supply that feed gas. But the key point is we are very, very reliant on these new projects coming online. So really that's the key factor to what any slippage will have significant impact on price formation across each of the kind of key global gas benchmarks. So thank you very much for your attention, and please stay tuned for the next session. So welcome to our session on carbon markets with a focus on the EU ETS. So the long-awaited tightening of the EU ETS appears to be well underway, with DEC 26 futures trending above 90 euros per tonne in January so far. Now, as always, EUA price formation is set at the balance between relatively rigid supply, which is ultimately policy-driven, and market-based demand. And supply is definitely tightening significantly through 2026. So we have that 4.3% linear reduction factor taking away about 83 MT, and then we have a one-off rebasing of 27 MT maritime emissions fully incorporated as well. But also beyond the supply reduction, we are seeing a change in distribution of allowances as well. So we're seeing benchmark revisions for the 2026 to 2030 period, which are going to influence the free allocation to industrial consumers or producers. So that's going to be significant, because we calculate a 15% reduction in free allocation from 2025 to 2026. And what that's going to do, it's going to expose a greater share of Europe's industrial base covered under the EU ETS to carbon pricing. So instead of the passive management of free allocation, we are going to have to see more active hedging. And it is industrials that are the center of this, with the growing short position effectively driving price formation going forward. So up until now, really, the market has been balanced by power fuel switching. Now, obviously, power producers have big, sophisticated trading desks. They're able to hedge underlyings on a long tenor. The opposite is true, really, for industrials, which really are quite heterogeneous across industries, but also within industries. And so that hedging dynamic is going to be vitally important on a go-forward basis. And really, at the moment, it's very uncertain what that looks like going forwards as we get through into this broader tightening regime. Now, what's important, therefore, for price formation is when this growing deficit for industrials, which we term, a paper imbalance, transitions into what we'd refer to as a market imbalance. So effectively tightening in terms of demand, physical demand for allowances. Now, if we do see meaningful forward hedging, we could effectively see that deficit in any given year, that as we see in the later 2020s, pulled forward. However, if we don't see that hedging take place, and if we don't see that forward-looking behavior, instead what we could see is effectively industrials using their already accumulated free allowances to meet current year compliance requirements. So that's critical going forwards. So where do prices actually go in the long term? Well, it's effectively based on that marginal cost of industrial decarbonisation, and that is really set above 100 euros per tonne, very unconstrained at the moment, but there's a general consensus in the market that that is really where we need to go. So really that rally that we've seen so far through 2026 has been driven by that belief and that consensus in the market, but importantly, it hasn't yet been driven by firm industrial buying. Instead, what we've seen is speculators, in effect, getting ahead of that tightening and buying significant or building up significant long exposure, driving prices up to 90 euros per tonne. Now, of course, speculators, they don't have a compliance requirement. And so therefore, those positions can be quite vulnerable to drawdown. So very happy to be joined by Vincent, our kind of lead energy trader. So What have you seen in terms of speculator activity in the EU ETS? And do you see a significant long liquidation risk given the relatively stretched positions that we're currently seeing?
Hi. Yeah, rightly so. We've seen since the middle of the summer of last year quite an aggressive accumulation of speculative long position on the EUA market. We opened the year at all-time high in terms of spec length positioning. Has been concomitant with a really soft implied volatility environment, very soft option market environment, which has opened the year with front-end volatility trading around 16.5%. That's the low of multiple years. The ascending channel that the speculative position was built on pushed the market from about like 70 euro a ton up to 90 euro a ton early in the year. The last push, the last increase in spec length has triggered an upward out of range move on the front end of the EUA market, triggering a short volatility squeeze. We'll have confirmation over the past couple of weeks with the commitment of traders. But I do believe that some of that spec length got out on the short squeeze middle of last week. And right now, what we're experiencing in the EUA market is most definitely a big, significant unloading of that spec length. If you think about it, that length was accumulated over a 40% rally in prices. So I think it's reasonable to expect some of that positioning to unwind given the return. But like historically speaking, that spec length tends to reaccumulate after sessions of boarding. So in the very near future, we do believe a stabilization and maybe like a softening of prices before resumption of the spec length accumulation.
Perfect. Thanks so much, Vincent. So I guess we could summarize by saying, upside bias, but as always with EUAs, not necessarily a one-way bet. So now I'm quite interested to turn to Marika. So clearly we are seeing a structural tightening of this market and growing exposure to carbon prices for compliance entities. So have we seen a change in compliance entity behavior in response to this?
Yeah, I mean, it's been an interesting time because I think, we've come off of a period where the price was fairly stable at low levels, meaning everyone was looking at it. And yes, we still saw some hedges and we still saw some requests for, entities that had already purchased their compliance requirements to get them financed. But it had come down on the back of the pricing, and obviously with levels going up now, and if anything, the tightening finally ready to happen. I think for a lot of compliance entities, they're really considering again what to do and how to hedge themselves going forward. And obviously, you can always hedge yourself through the long futures. Some people will also, with entities that had free allocations, or build up positions, like sitting on those for a longer period of time with obviously the value going up. It can also be interesting again to monetize those and see if you can get additional forms of liquidity. So we definitely see the change coming. I think we see, quite some producers with heavy requirements coming back online with questions we saw a few years ago. I'm looking at my requirements for 20, let's say 5 to 10 years forward, because the short term is hedgeable. You go further out, hedging becomes more difficult because we don't really have that forward market, but people are still looking to look in that price. And that's where some of the structures that we've seen developing in the market, where entities can acquire their EUAs today and then put them in vehicles and have them carried by, financiers or structured providers, is all of a sudden a very viable solution again. It always goes hand in hand, obviously, with interest rates. Like it was, I think in the last few years, it was also a combination of low prices, but also high interest rates where financing a carry isn't necessarily very attractive. But with some of the cuts and, you know, maybe even some more cuts on the horizon, all of a sudden, I think that option will start picking up again.
Okay, perfect. So I suppose it's, you know, that long-term hedging coming in, which is going to underpin a structurally higher price level. And I think the key question therefore is, well, what could go wrong if we are seeing appetite for these longer term hedges? And really the key question for us on that is the policy risk, because tightening, of course, is policy driven and can change, particularly when we consider the major reviews during 2026 on the EU ETS as a whole, in the context of the newly agreed 2040 90% carbon reduction target, but also on the MSR as well, so market stability reserve, which we'll cover broadly as part of the wider review, the position of carbon removals in the system going forwards. We also have a review of CORSIA as well in terms of whether we see long haul flights departing from the EU covered within the ETS. So clearly a lot can change on the policy side. But the base case that we have is that we won't see any significant change going forwards. And that's because we think politicians will argue that the CBAM is being introduced, and that will protect industrials within Europe, industrial groups within Europe, despite those higher carbon costs. Now, we would say that the prior period of carbon price rally in 2022 was associated with a wider energy crisis. So it will be more difficult to argue that point because really EUAs can't hide behind €300 per megawatt hour TTF this time. However, we do think that CBAM argument will be relatively persuasive when it comes to the broader politicking around the post 2030 EU ETS. And so really what we wanted to do for the next question is bring Bernard into the discussion. So our metal strategist, obviously reviewing the impact of CBAM on metals producers in quite some detail. So really, what are you seeing in terms of the impact of CBAM, and is it really truly going to protect metals producers within the EU?
Good question, because you talk about lots of change also on the policy side. And if we talk about CBAM, there's been changes every quarter possibly to CBAM. I'm going to focus a little bit for the sake of our example on the aluminium sector, although CBAM also encompasses steel and some other minerals. But for the sake of the policy change, for instance, the last quarter, everybody was stressed out about CBAM. Okay, it's a lot of paperwork, it's complicated paperwork. Just to let you know, CBAM, when you're importing aluminium, let's say it's the importer, the onus is on the importer, it's not on the consumer to fill out the paperwork. It's not necessarily on the producer, but it means that the producer is also bound by putting special emission sensors, being able to properly fill some of the paperwork to prove what his emissions are when he's abroad. And so the big issue was that, for some of the small importers, that would have been a pain in the neck and extremely expensive for them to do. So the amendment in CBAM, which came out last quarter, was basically you are exempt from filling or paying for CBAM up to a specific tonnage. Okay, so effectively what happened is that like 90% of importers received an exemption, which was quite appreciated. But when it comes to the impact on protecting the local producers in Europe, in principle, yes. In principle, also, what would happen is that Europe would be attracting the lowest carbon emission aluminium. Okay. That will come at a cost because the premium has to go up in Europe to be able to attract this low carbon emission from, let's say, hydropowered dams. And so you would end up with a large cost on the end consumer in Europe. And we had calculated that by 2034, once you have to pay 100% of the CBAM, that could be something like €400 on top of the premium. okay, in terms of CBAM. So it's quite big. Now, the problem is that you're assuming here that everybody's going to play fair game, which is not going to happen. First of all, when you're auditing, who is going to go out and audit in the deepest, darkest bit of some smelters in Asia? That's an issue. If, let's say, in India, some of them come up with saying that they're producing their aluminium using very low carbon PPAs agreements, who's going to check that there isn't multiple pledging on those PPA agreements? Mm-hmm. And the final very important point also is about scrap, because scrap has the lowest carbon footprint by far. So what happens if there is greenwashing of some of the scrap? You start with very dirty primary scrap full of coal, let's say. Primary aluminium that's been produced using, extreme example, coal power. You just send it to another country and they say, oh, great, it's scrap now. We'll send it to Europe and it's 0.3 tons of CO2. So all these questions which remain unanswered and which could be really frustrating for the local producers in Europe, who are, I would say, playing fair game, who are being very closely inspected.
Okay, very interesting. So perhaps some adjustments once the scheme is underway and some of those factors are...
As we go.
So Marika, final question for you. Obviously with CBAM, you either pay the tariff at the European border or you can levy that tax yourself domestically. So are we seeing in some of the kind of like key industrial importer nations into Europe development of domestic carbon markets to effectively capture some of that revenue?
No, I mean, it's an interesting time that we're living in, right? Because I mean, with Trump being in power and tariffs having come across the board, obviously it's already a very different level of playing field than when people started thinking about CBAM. But yes, I mean, if you are a country with big producers, where the EU came in and with CBAM has sort of tried to set a level playing field effectively across the globe, you're going to see similar reactions in other countries. And so, if you have a few big producers with big requirements, they're either going to pay a lot of money to the EU ETS, which then Europe can use to its own benefit to invest in its own energy transition, or you implement your own tax, and as you rightfully say, that tax then gets to be reduced from what is being paid to the EU. So I do think that, that can come through the form of new ETSs, it can come through the form of another CBAM in other regions where you can start netting things off. I mean, I think the complexity by itself of all these different initiatives across the globe are very challenging. And on top of that, I mean, what we see in the US with Trump, obviously not a supporter of climate change, some of the well-established programs like the California Cap and Trade program all of a sudden could potentially be attacked again, something he also tried to do during his first presidency. So it's a very interesting time, I think, to see what's going to happen across the globe. And I think when you're a global player, there's multiple different developments that you're going to have to monitor in terms of deciding, where you're going to produce, where you're going to sell, who role of intermediaries, because as Bernard rightfully pointed out,
rerouting.
Right? I mean, it's the person that's importing that ultimately is paying the tax. That doesn't necessarily have to be a producer or consumer. So it's an interesting, I think, environment to be in at this point in time.
There was also a point about CBAM was that if you've already paid the tax or some taxes, as we were mentioning, in another country, some emission taxes, then you can just deduce it.
Yeah.
Yeah. Now, the problem is, what standards are we talking about? Are they comparable with EU standards or not?
Yeah.
Are they, following the rules precisely or not? So that's another complication facing.
Perfect. So thank you both, and thank you, Vincent, for joining as well. We can probably summarize our carbon session to say there is structural tightening underway, really, for EUAs, but really that's policy driven, and with a policy driven market, you introduce policy risk. So a lot of that policy risk is going to be tied to the performance of CBAM going forwards. So definitely something to watch in the next few years. Thank you very much, and we'll move on to our next session. So hello everybody, welcome to our session on oil markets. So once again, oil prices don't seem to be cooperating with either the consensus or fundamental balances with what is perhaps the most anticipated oil glut in history kicked down the road once again. So despite consensus balances and our own balances actually pointing towards significant oversupply in Q1 26, we've seen dated Brent trading towards $70 per barrel through mid-January on some geopolitical related stories, so Kazakhstan and threat of losing Iranian barrels, and that's despite on paper very weak balances. And really this is a repeat of some of the trading dynamics that we saw through 2025 with consistently weak balances through the second half of the year not being reflected in either flat prices or market structure. So to help kind of answer the question of whether we are going to see this oil surplus show up and when, we'll be kind of discussing the key trends which help to obscure that oversupply in 2025 and whether we think that they'll be relevant in 2026. Now, from the research perspective, one of the key themes in 2025 was the behavior of key off-market, shall we say, barrel sinks. So these helped to absorb excess supply and prevented a significant build in OECD stocks. So despite those really weak paper balances, we didn't actually see that reflected in stockpiles and key pricing centers. Now, the key trends last year were the very strong Chinese crude imports beyond the level required for domestic refinery runs. And so a lot of implied strategic stock building via the SPR. But we also saw a big increase in oil on water as some of the kind of geopolitically exposed producers facing sanction like Russia, Iran and Venezuela faced a more difficult route to market, particularly Russia in Q4 with Trump announcing sanctions on Rosneft and Lukoil. Now, on top of that, we had that geopolitical risk being heightened through 2025, and with OECD stocks relatively low and then moving towards average levels towards the end of the year, we're probably a bit more exposed to those geopolitical outages, and the price response is higher. So these were the key factors in 2025. And when we look, the key question is, when do we see OECD builds show up in 2026, if at all? Now, our base view is that some of the factors that were relevant in 2025 will reverse. And in Q1, we do think that Russian material that's been stranded, so to speak, will start to clear in some of the kind of markets that are willing to take those barrels, China in particular, but India as well, Turkey too. So when we look at our on-paper S&Ds, about 1.8 million barrels per day of oversupply on paper through Q1, we do think a fair share of this should be reflected in OECD stocks. So that's our kind of research view. I would say that we don't think prices will move too low, and we are a bit more bullish than the consensus. So our average is around $62 per barrel for 2026. And the key part of that is that we do think as OECD stocks build, OPEC will come into the market. We do think we will see Chinese stock building maintained at relatively high levels. And we do see US production relatively weak at the current price deck as well. But in our base case, we do expect prices to start moving lower as these OECD stocks build through Q1. So that's the research perspective, but very happy to be joined by our lead oil trader, David Cooper, who can elaborate on some of the trading dynamics that we saw last year and the relevance that they will have for 26. And so, David, the market's held, this bearish view for quite a while. It's not materialized. So how has the market kind of dealt with trading this dynamic, and have you noticed anything different in terms of how the market's positioned for this theoretical oversupply in 26?
Yeah, it's a very interesting moment for the market. I think obviously the consensus that we have, the market, as the general players of the market has had for some time now, is that this oversupply will happen in Q4 and definitely into Q1. And I think the biggest change that we've probably seen is the prompt structure. We had seen some quick contangos coming into the prompt area pretty fast when it felt like that the oversupply was going to materialize in early Q1. And I think really what's that's actually manifested itself is a bit of a false dawn on some of the trading activity. So I think the market stopped really looking for that large contango coming in, and that again has been completely expunged by the points you made earlier about the Chinese SPR. Currently this year we've seen the CPC issue as well, and actually what that's actually turned around, that's actually made the backwardations quite spiky in the very near end, and also onto the DFL as well, the dated front line. Currently we're over 240 for balance of Jan. So I think that really demonstrates the tightness that can quickly kick into the market. So I think that element of the market has gone. The interesting fact that how do we price in geopolitical short-term moment versus the oversupply that the market's looking for, and it's become a very difficult narrative. Now, as always, the thing with marketplaces is that if everyone has the same consensus, it then becomes a very difficult moment then for that to change. So we have seen stopping that in the market. We've seen a higher activity on options for upside protection, and I think the market is kind of really struggling or questioning this whole narrative. And as Giles rightly pointed out, I think there are some commentators looking for very much lower numbers than we are. And I think this market is demonstrating how difficult that is to price in that geopolitical spike when it happens. With the material not really coming to market on the sanctioned barrels that we've touched on with Venezuela, Iran and Russia, that will obviously, there will be some workarounds there, and I think obviously that will manifest itself in coming to market, and I think that will put a bit of pressure on the market overall. But I think overall the market has actually priced in and has been pricing in where we've seen the market, and we've only made a couple of moments through $59. And I think that just shows you the resilience of this market at the moment, and the difficult conditions of getting this spot market versus kind of the medium term in play.
Yeah, I think the phrase that we kind of settled on to define the market of the second half of last year, and really it's carried on into this year, was show me the barrels. I mean, it's fine to have these paper balances, but until we actually see them building in pricing centers, the market, as we say, is going to continue to be defined by these short-term punctuated spikes, and ultimately these outages they keep piling up and showing up just as we think the balance is going to loosen, and we will see some of those moves on structure lower and also on flat price. So again, happy for now to keep that maybe above consensus forecast, particularly given those floor kind of dynamics we talked about with OPEC, China SPR, etc. But Eugene, question for you. Be very interested to get the sales angle. So how have corporates been looking at hedging this dynamic for 26, where you have that bearish fundamental view, but prices maybe aren't cooperating?
Yeah, so Joe, I think most of the consumer customers that we have entered 2026 with a kind of a bearish flat price bias. And consensus actually has been to scale into hedges below 60 Brent levels. Obviously, the geopolitical spike has actually caught many of them off guard. But they have been rather patient. Instead of chasing the rally, the response has been pretty much focusing on from a defensive stance. So locking in shorter dated hedges and seeking some protection through option structures. So given that we are nearly $2 off the recent 2026 highs, and the material base case bearish view has not changed. Consumers are still adopting a wait-and-see approach and keeping their powder dry. Also, the gasoline cracks weakening, distillates holding only at mid-cycle levels. Fundamentals haven't supported aggressive flat price coverage despite elevated geopolitical headlines. I mean, who knows? They could be right.
Yeah, it's very interesting. I think wait and see is the question for, or at least the narrative for now for prices and participants in the market. Next week, we are going to take a look at gas oil cracks. So from, given the volatility that we've seen in 2025, which is really, continued in a kind of semi-punctuated way since the initial Russian invasion of Ukraine, what can we expect in 26? Well, ultimately the structural problems do remain. So Europe has lost its natural supplier at a time when the refinery sector domestically has been undergoing rationalization, and we do hold the view that there's enough refinery capacity on paper, but whether it's in the right place and can supply the right markets, especially given some of the problems we've seen logistically with the Red Sea, so there's canal issues, for example, making journey times longer, that's a bit more of an open question. And when we are seeing outages, particularly through refinery maintenance periods, these cracks are incredibly spiky. And we do think really that we'll see more of the same through 2026. We are seeing refinery capacity growth, but a lot of this is concentrated east of Suez, and a lot of this is concentrated in India, actually. And so the capacity for these barrels to be able to supply Europe promptly through these periods of tightness that we may see due to geopolitical events in Russia, for example, or just the general operational issues that sometimes crop up, it means that ultimately cracks are going to kind of maintain this dynamic, and we do expect a $20 floor for Northwest Europe cracks to be maintained on gas oil. So David, from the trading angle, I mean, what did you see on gas oil last year, and what do you expect for 2026?
Yeah, I mean, I think we were thinking last year, and we put two things out. Show me the barrels is a very good statement that we put out as regards to kind of the crude side, and we'd also touched on last year in Q4 about how we saw that the market, although felt there was enough refinery capacity there, that if there was a perfect storm around some of the middle distillate, things could get quite difficult. And I think, we did see that. I mean, we know that the stocks globally are very low for middle distillate. We have seen refinery activity utilization really pick up, especially in the US, and at that moment in time, we did see some very difficult moments. Although the margins were very good overall, we did see some very difficult moments for the market from the paper side as levels went up. And it's very difficult to find natural sellers to step into those moments of spikiness or the moments of tightness. Especially when we're examining what's going forward as regards to how we see sanctioned barrels operate within the refinery space and how that refinery material gets imported into ARA. So what's changed? Not a great deal. I mean, we're still in this moment in time. I think I've been surprised, like many, that the middle distillate stocks globally have struggled to replenish. We've seen it on other areas of the barrel, but middle distillates is stubbornly stand towards the low side. So I think we move into this year in a very similar kind of momentum, where we look at the market overall and we feel, okay, there is comfort, the market feels comfortable. But have we seen it already this year where and also touching on a little bit what Eugene was saying, as customers are sitting there going, oh, I'm patient, I'm waiting for dips, as that doesn't materialize, I think that there are still hedging programs that still have to be facilitated and have to step to market. So I think this year that we've already seen some spiky moments around the middle distillate space already, and there's been some high activity already witnessed. So I think that perfect storm there is a possibility of that, especially say with around the import activity. So something to be very aware of. We've seen what's happened already, and I think the same applies into Q1, into the end of Q1 into Q2. So that moment's still very, very relevant with us at the moment.
Yeah, and I would say as well from the spec side, we have seen a really strong willingness to participate in some of that upside with, the initial kind of spec long position really building up through that summer period following the Iran-Israel kind of 12-day war last year, and continuing really as we saw various Russia supply issues pile up, from drone attacks to sanctions on Lukoil and Rosneft, and then finally the third-party refinery ban. And so whenever we do see these tight moments, the specs are really pouring fuel on the fire for that upside. Eugene, is clearly a really strongly volatile environment. So how have customers been kind of dealing with their hedge requirements, both from the producer side with the intense kind of backwardation? So if we've seen refineries willing to lock in some of those longer dated cracks that perhaps aren't reflecting that prompt value, and then also from the consumer side, given some of the upside numbers that we've seen.
So generally speaking, I think activity has been pretty much asymmetric across participants. So on the consumer side, we still see genuine buying interest sub 60 Brent, but little urgency at current levels. I think if prices do push back towards $70 Brent, I think that's where we are likely to see some reactive or panic-driven buying rather than conviction-led coverage. On the opposite spectrum, producers have been pretty opportunistic, and proactive, using geopolitical-driven spikes to add hedges. While refiners, I think they are increasingly engaging through options to re-establish upside exposures in cracks, aiming to recapture last year's highs without fixing margins outright. Overall, the pattern of activity reflects low conviction in the sustainability of the current move, even as participants remain mindful that geopolitics has a tendency to force rapid repricing when least expected.
Perfect. No, thank you so much for that insight. And really, I think that really sums up the session pretty well. Low conviction, wait and see, more volatility on geopolitical related moves, very likely to continue to be driving oil markets in 2026. So thank you very much for attending, and thank you, David and Eugene, for your contributions.
Thank you again for joining us on the base metals session right now. Joining me here from London is Barak Marks and Thomas Hodge. From New York, Charles Vick is joining us. So the topic we have here, or the title for this session, is the price rally in base metals. Is there a dislocation between fundamentals and prices? So from my take is, from a purely fundamental perspective, there is a dislocation. Put it that way. I don't think the current prices of around 13K, let's say, in copper are justified. We're seeing much of this dislocation due to some of the trades taking place, imports taking place into the US, which I think we'll ask Barak about later on. Thomas, I mean, from a trader's perspective and what you can see in the market, do you see a dislocation in the market?
I think there's inarguably a dislocation in some of these metals. I mean, my two favorite examples for the purpose of this discussion are nickel and tin, both of whom have had pretty spectacular rallies in very short periods of time. I think nickel really started moving about mid-December and has had a huge rally since then. And tin was up, I think, 11 or 12% at some point last week, trading at all-time highs. Usually what you'd expect to see is if we had some kind of demand and or supply shock, and it was remotely imminent, is that the shape of the forward curve would be in a steep backwardation. And that's just really not the case in either of those metals. Nickel is in a steep contango, completely in contrast to what you'd expect. And I had a look this morning at the shape of the tin curve, which is also in a contango, but more remarkably, it's in more of a contango than it was 6 months ago when the prevailing price was several tens of thousands of dollars lower than the one that prevails today. So something's out of whack. Of course, it could be the case that what we're seeing is a significant amount of forward buying driven by the market, discounting something which is going to happen in the future. But I would say to that, well, okay, that's possible, but why has the market only suddenly tumbled to that conclusion? I think actually what's happened is that we've had this huge rally in basically things with an AI theme. Obviously, that's been seen in US equities over the last year or so, and it's just starting to catch up on the industrial metal side. And people have also seen the huge rallies that we've had in precious, so they look at something which is vaguely connected thematically. Certainly, batteries are, so nickel, I guess. And there was some fundamental input into that as well. But, tin uses basically electronics. I think it just looked cheap in inverted commas. It's a very thin market. It frequently gets pushed around, especially by commodity trading advisors. But yeah, I think there's definitely a dislocation.
So if I were to concise or to resume everything you said, you kind of think there's some speculative or non-end consumer demand positioning taking place as opposed to the traditional industrial demand. So there might be increased investor demand, increased speculative demand. Is that what you're seeing also?
Yeah,
we even heard about trading houses was trading oil, jumping in and starting to trade copper recently, and everybody joining the new El Dorado, it seems.
Yeah, no, I think that's certainly true. I mean, I think some of the new entrants to this space, it inevitably can push prices out of whack with the fundamentals, even if they're sort of right about where prices will be in the medium term. I mean, don't forget, Bernard, you're old enough to remember the last time we saw this movie, which was in the sort of 05 to 08 timeframe, where again we had a huge run up in copper that was arguably driven by fundamentals because of the China story, but I think inarguably a big part of that rally was also driven by essentially speculative inputs in the market, either from the hedge fund community, but also from the then sort of new commodity index products being deployed into that space. Of course, we're the best part of 20 years later, and it's not exactly the same, but it at least rhymes with the situation we had before. I mean, just to touch on the investor flow, particularly in copper, this has been very evident, I'd say, over the last 6 months, even with the volatility we saw with the various tariff hokey-cokey from last year. We started to see a sustained bid further down the curve for copper vol and upside structures, and really the only people that would provide that or demand into the market is the investor community. I mean, typically consumers wouldn't be hedging with products like that. So
okay. If we move on from the investor community side, and I talked to Barak on more the physical flow side of thing, obviously 2025, the big story was tariffs and the impact that tariffs had on, let's say, copper. Do you see how is the current US tariffs impacting base metal prices, notably copper? Yeah. And do you think these factors are going to remain as a topic for 2026?
I mean, I think we can go back to last year and this year that copper had a really good performance. So from a fundamental side, are higher copper prices justified? I would say probably yes. However, we just talked about dislocation. Have we gone a bit too much? I would say probably yes as well. So if you go back early last year, at the start of the year, we had rumors of potential import tariffs of refined copper, which resulted in copper COMEX trading at a very big premium to the LME prices. This prompted a lot of traders to shift basically their shipments from any place in the world to the US, basically to benefit from this large dislocation in prices. And as a result, we had also a dislocation of physical metal. So a lot of metal ended up in the US, while there was not necessarily the consumption for it, while the rest of the world was really in a deficit.
Yeah.
And this obviously put even more pressure on copper prices and a more bullish sentiment. So by July, the administration announced that tariffs were not going to apply to refined copper, which means that the gap between copper COMEX and LME narrowed a bit. However, we're not out of the woods yet because there are still talks of potential tariffs on refined copper. So the US is going to revise their decision probably by the end of June. So we could see potential tariffs going to copper again. Now, the question is, if there are tariffs, there's only talk of 15%, which is going to kick in. And I think this is not really sufficient to, again, divert all the metals into the US. So I think at the current state, there's loads of warrant stock and unwarrant stock in the US, probably around 850 KT, which is more than sufficient to close their supply gap for this year in the US. So I think if premiums are decent outside the US, we're going to see shipments divert back to the rest of the world. This is going to put less pressure on really copper, and we're going to see prices going down. So they're not going to be where we are today, at least in my opinion. So to answer your question, is it going to play a role this year? In a sense, yes, because whatever the decision is, in my opinion, whether there's going to be tariffs or not, I reckon prices are going to go down. And we're still also waiting for a decision whether import tariffs in general are legal. Yeah. So that's another decision we're waiting for, and this could happen in the next couple of weeks. So under the assumption that they're illegal, we'll potentially see a very quick and sharp drop in copper prices.
On the topic of like physical movements, can you tell us a bit more about aluminium? I mean, there is talk, right or wrong, I don't know. You'll tell us about trading houses and warehousing movements impacting aluminium prices. Is this a fair assumption or not? I mean, does it impact actually prices or not?
So LME aluminium obviously had a very good run this year. I think, again, we're running way above fundamental levels. So looking fundamentally, I think there's a strong story. So there's a demand for the green transition, electrification. So I think the demand is there. In terms of supply, the Chinese are basically producing their self-imposed cap, which means they're going to export less. In Europe, over the years, a lot of smelters shut down, so they're producing less and there is less availability. So there is a story for aluminium to go slightly higher. But what we've seen in the market, I think, is aluminium really followed copper. So when copper really started rallying, it caused aluminium to start rising again. And once there is a trend, you have all these CTAs and funds really piling up on the trade. And in addition to them, you have all the trading houses you mentioned as well. So they're all piling up at the same time. And as a result, aluminium prices are much, much higher. Is it because of the trading houses when we talk about outright prices? I don't think necessarily, but where the trading houses and their physical play really impact the aluminium market is really within the spread. So all these trading houses, and especially all the new entrants, what they're interested in is in the physical play. So taking up potential premium warrants, going to a rent deal, rent shares. So they're really in the market for these kind of trades. So what I think is currently happening in the market is that there is about 450,000 metric tons of aluminum in LME warehouses, and probably around 250K is non-Russian material. Now, aluminum premiums in the world are quite high. So Rotterdam duty unpaid is around 270. The Japanese premium is around 170. So there is really an opportunity to pick up warrants from the LME for free, which do have a high premium in this physical market. So what do trading houses could potentially do? They just go long the spread in size in the hope to pick up the non-Russian material. And I mean, the moment they borrow more than 200,000 tons, they will get non-Russian material. And this also gives them optionality, because if they go very long the spread, and it suddenly go very tight, they could just lend it and take a profit on it, just rather than picking the physical material. So in this is where these trading houses really affect the aluminium market when it comes really to spread trading, and that's why we observed quite a bit of tightness over the last year within those spreads.
Thank you, Barak. We'll move on to Charles. So, Charles, we had the trader's view, now we'll have the origination view. Charles, like from a hedging perspective, we're seeing sky-high prices. Obviously, it's a different story if you're a consumer versus a producer of those base metals. Is the hedging activity like the strongest it's ever been, or it's not necessarily the case? And the second question, which is a sub-question, whilst answering that question, Charles, if you don't mind telling us if there are like regional differences in hedging, basically.
Yeah, I think you've already touched on one. If I were thinking about 4 categories, if I were assessing whether this is a good environment: 1, producer versus consumer; 2, where are we in the price point? Like, where are we now versus history, whether that's a 1-year look back, a 3-year look back, or a 5-year look back. Number 3, how do the hedges layer into your business from a profit margin perspective, from a cost perspective, from a revenue perspective? And then 4, how flexible is your hedging program? Do you have, the traditional systematic program, or do you have something more flexible that allows you a bit more opportunistic abilities? And if you think about in those 4 contexts, I really do think that this environment is not exactly the most ideal. It's extreme, as Tom and Barak just kind of went through. What we've seen, particularly in precious metals, certainly some in base metals, especially with copper, but even aluminum, zinc, tin. These are all extreme price moves, extreme price points. And so if you are on the consumer side, it's a more difficult play locking in at such high levels. Especially if you believe in historical theories about mean reversion, et cetera, it's difficult to buy at these types of levels. And so you tend to be more patient, or hope you can be more patient and wait for, a price correction. If you're a producer, this is ideal. If you're a copper miner, typically, or something to that, or a processor, you'd hope that you would be very bullish these numbers. But again, you worry that no one thought silver would be where it is now a month ago, and no one thought a month ago that silver would be where it was a month ago. So I think the issue is the progression and the extremity of the price moves being producers or the consumer. Obviously, this favors producers more than consumers, but I do think what challenges most risk managers at this point in time is price point. How do they justify this internally? And it becomes a little bit more difficult given the uncertainty around tariffs, given the uncertainty around trade flows, given the uncertainty about just their own businesses at these price levels. To your second question regarding
regional difference.
And just one last point. I do expect potentially the hedging activity to pick up if we see moves that are a bit more consistent. So if we start seeing mean reversion, some correction, I could see the consumer side coming in a bit more. I could also see the producer side rushing to get what they think may be the last, high price point. I think to your second question regarding regional differences, I think the North American corporates tend to be more regimented and systematic. And so they tend to be less flexible with their hedging programs, particularly on the consumer side. In Europe, auto manufacturers we've seen over as an example, tend to be more opportunistic, tend to be more flexible, and can, lock in 2 to 3 years forward, as an example, in PGMs or otherwise, something that US automakers almost never do. So I do think there are differences such as that. And in Latin America, I think it's a bit more flexible. It's a little bit of a blend of the two. They have a program, but I think it does allow them to be a bit more flexible when the price point presents itself. So I do think 3 regions, 3 different sort of methodologies around hedging. I think in this type of market, you probably need to lean more into the blended, have some level of baseline hedging, and but have the opportunity and the flexibility to lean into hedges that, you know, when the price point presents themselves.
Thank you, Charles. And this concludes our base metals session. Thanks a lot for your attention. Hello again. Joining us now is Marieke and Jean-Baptiste Melaine from Paris, and Aaron Fleming. We're going to talk about uranium. So it's back in the spotlight. We've got the German Chancellor saying recently that there was a strategic mistake to have exited nuclear power. So uranium is back in the foresight. Marieke, can you give us some color before we go into the depth of the topic, but some color on the uranium market, which is relatively small, if I understand?
Yeah, no, of course. Yeah, I mean, I think you're spot on. I mean, you know, I've started looking at this market 5-6 years ago, and what we can see is obviously on the back of the energy transition, we've seen nuclear demand almost triple towards 2050. On top of that, we've seen some tech data companies coming in with new demand. So it's been an interesting market to follow. Over the last 2 years, I mean, the price has gone up. Obviously, there is, you know, when we talk about the price, we can either see the spot price or the term price. Term price has always been very stable. Traditionally, you know, there's good demand from you know, the utilities and the nuclear reactors for the price, but spot price has seen some volatility. I think mostly driven as well by obviously some of these tech data coming in. We've seen investors coming into the market. I mean, we've recently been to another price rally from sort of mid-70s per pound, say October, November time to, I mean, less prices going around $85 a pound, which obviously is quite a sizable increase. So it's very interesting. I mean, on the long term, I think there's a lot of consensus in the market that we're looking at a structural deficit. Mm-hmm. It's more timing wise, you know, when is that deficit going to happen? You know, there was enough initial supply in the market, both primary as well as secondary, but ultimately new investments will be required. And so is demand going to pick up more? And you know, when are we going to really switch over to the deficit is, I think, one of the key questions that we see today.
Thank you, Marieke. I'll move on to Aaron on the point that Marieke was talking about. Are we seeing, with regards to acquisitions, Aaron, are we seeing a lot of development when it comes to uranium assets? Is there much movement there?
Yeah, certainly. The last 24 months has seen a wave of consolidations and change of control deals. The most significant was Paladin Energy's acquisition of Fission Uranium, which closed in December 24, creating another top-tier global producer, market cap north of $3 billion. In the US, Uranium Energy Corp finalized its purchase of Rio Tinto's Wyoming assets in late 2024, and through the course of 25 achieved fast-track federal status for its Sweetwater mill. In addition, we saw Encore Energy consolidate its position, surging production by 300% in 2025 after a major leadership and asset overhaul. When we turn to look at 2026 and from there forward, we think we're entering a delivery period. And Marieke talked about structural deficits on the horizon in terms of primary production. In addition, with uranium spot prices at significant levels and maybe even trending towards $100 a pound, the focus this year is less on buying assets and more on the de-risking and development of projects to get them into production.
Thank you, Aaron. Now, question for you, which might be topical and more geopolitical, but with China having a hand on a lot of the commodities these days, where does it stand in all of this?
Yeah, it's pretty clear being based here in APAC and on my way to Beijing right now or very shortly, there is a speed gap between the East and West, which is quite visible. While the Western firms are consolidating existing assets, similar to those examples I just referenced, China is building and listing entirely new ones. In December 25, China listed its first dedicated uranium stock, CNUC on the Shenzhen exchange to fund global mining expansions. China's project building speed is also unmatched. By example, they completed the national #1 project in Inner Mongolia in July 2025, taking just 12 months from groundbreaking to the first barrel. It's fair to say no Western project moves at that speed or has moved at that speed to date. CGN Mining, listed in Hong Kong, also reported production beat in 2025 from its Kazakh joint ventures and demonstrating their integrated model to be quite efficient from mine, refinery to reactor. In contrast, the West is playing catch-up through massive state-backed capital. In October 2025, it was announced the U.S. government entered into an $80 billion partnership with Cameco and Brookfield to deploy Westinghouse reactors. So while you could say China leads on speed and domestic integration, the US and Europe are definitely responding with massive capital injections and permitting reforms to secure their own supply chains.
Okay, well, thanks a lot for your time, Aaron. I'm conscious you have a plane to catch. I'm just going to move back to you, second, Mariki, because you had mentioned previously to me about Chinese developments on the border with Kazakhstan. Can you tell us what's happening there and why on the border with Kazakhstan?
Yeah, I mean, so traditionally there were only 3 locations globally in France, in the US, and in Canada where international players could hold uranium concentrate and uranium hexafluoride. But what we've seen is that, as Aaron alluded to, I mean, China is clearly making a lot of investments. I believe that they're planning to grow to 200 reactors by 2030. So that's a sizable growth, potentially even looking to outpace the US as the biggest buyer in uranium. And one of the key questions in this market with the structural deficit we're seeing is obviously that you need to secure that supply. And so in the third quarter of last year, there was a new storage location that opened up at the border of China and Kazakhstan, Alashenko, which now also allows international players to open holding accounts. Obviously, a lot of what will go there will be production from Kazakhstan, which is still the #1 producer in the world, going into China.
But I think it was 40% of world production or something?
Yes. No, I mean, they are still a very dominant force in this market. And with the growth that China's seeing, obviously, for them, they consider them to be a key partner. And with the storage location, gives them a chance potentially to secure more of that supply. It's early days. It's only been up and running for a few months, so it's too early, I think, to say what really the impact is going to be. I mean, we've seen obviously on the back of the Russia-Ukraine war that the transport routes have changed because some of the material from Kazakhstan used to be transported via Russia. That's no longer the case. So this is also a bit more on one of the potential routes, but it's a clear signal, I think, from China and from the market that they have ambitious growth plans in this market.
Thank you. I'll move on to our mining engineer who happens to have worked for a long time, if I understand correctly, in some uranium-related mine. Jean-Baptiste, if we take a step back and we just look at the complete supply picture, are we seeing a lot of greenfield developments taking place, or is it mainly expansions and reopening of existing mines?
I would say there is not only one answer to your question. I see we see all of them. We start seeing greenfield or robust greenfield development projects coming online, but the impact on the supply will be seen with the delay required to develop such projects. Of course, given the recent change in uranium prices, all producers are trying to increase their production to benefit from a better price condition. But it has limits, and the kind of limits really depend of the country, I would say, and the condition the mine is operating, and it may be related to reagent supply limitation. It might be related to social acceptance limited by still lower price than necessary to support high cost operation extra. So that's really depending on the operator.
Thank you. And
yeah, just to add that we are also seeing massive moves in the junior exploration sector as the exploration is starting to expand or to be seen expanding again, and that will be something that will allow, let's say, in a time scale of 10 years to secure the supply for a longer term.
So you're talking about 10 years time. When do you see, I think we've alluded before to supply deficit, but from your perspective, how do you see supply an imminent supply deficit, or is it a longer one that's supposed to take in a longer period of time?
Supply, is not imminent. There are some stock and some capacity to supply the market, but if we are expecting to see a nuclear generation, power generation capacity to be increased by 50% or 100%, depending on the scenario we are looking at, it will require a massive increase in terms of production, and it will start to have a real impact in the, let's say 10 years, between 5 and 10 years, depending on the capacity increase rate. Then it will start to become more complicated, and at that time, new greenfield project will really be required to support the energy generation.
Thank you, Jean-Baptiste. I'm just going to conclude with one question. We've covered properly, I think, the supply, demand, market color side of things, but I'll ask for your commodity financing hat for you to put it on, Mariki. How does one navigate such a small market, after all?
I mean, it's an interesting market, and I think if we compare it to some of the other commodities market, it's not as transparent. There is a lack of price transparency. There's a few dominant players. We talked about obviously Kazakhstan being one of the dominant producers. Russia used to be, or still is, one of the dominant players in the enrichment market, where you can see that the US is investing heavily in. But I think there is across the board, I think, a long-term view on growth in this market. What's potentially could be challenging, I think, is finding the right talent, the right people with the right knowledge to make those plans happen. I mean, for us as a player, obviously for France, the nuclear sector has always been important. So there's been some pre-existing long relationships, but this is clearly a market where people, work with people they trust. It's still based on relationships, and it's based on being in that market for a long time. So, I think the market faces a number of challenges, and one of them, I think, as well is as more players coming in, and we talked a little bit about some investor appetite, but we've seen some of the funds, and I think the Sprott fund is probably one of the key ones. I mean, they're currently sitting on 75 million pounds of inventory, which is very sizable.
And like $4 billion? Almost 4 billion?
It's even higher.
Okay.
I mean, you're like, all these players coming in are new players in the market that bring, I think, a new sophistication. I mean, we're seeing potentially the CME trying to launch a physically deliverable contract. All potentially, I think, evolvements that could have a good impact on the liquidity in the market, but it also makes it a different market. So for now, I think it's very much knowing the right players, built based on relationship, but it will be very interesting to see how this market is going to evolve in the next 5 to 10 years.
But thanks a lot, everybody, for your time. And on this, we'll conclude the uranium session. Thank you. Hello again to this precious metals session, risks facing the precious metals market. Joining us today is Adam Hendley, Priyanka and Pierre Chanel. The reason why we chose such a title is with the rapid increase of gold and silver prices, there are increasing questions as to the sustainability of such high levels, or if anything at that rate. And there are a few downside risks that I'd like to point out from my side, and a few upside risks. Some of the upside risks are quite obvious. I guess the Greenland story and annexation of Greenland is something that the market should pay close attention to, and is probably paying close attention to. The geopolitical scene will remain one at which I think is going to be potentially a big driver in the upside risks. From the downside risk of things, I think we're seeing coming towards the end of the rate cuts by the Fed this year, also potentially seeing a slowdown from central bank purchases as prices become such high levels that at the end of the day, in terms of tonnage, they wouldn't be able to purchase the same amount. And also some of the demand destruction, which in our low case scenario, if it becomes even sharper, then in that case, we could see prices of gold coming off and platinum prices benefiting. I'm going to start with Priyanka, because we were talking about those sky-high prices, be it for gold, be it for silver. Are we seeing a massive surge in terms of hedging or not?
Well, I think producers are perennially bullish. So despite gold and silver being at all-time highs, there's an expectation that sentiment will continue to drive prices higher. We've seen a few producers lock in a small percentage of their production, but not huge volumes. When I compare this to base metals, we've seen producers hedge Ali, nickel, copper, zinc quite systematically over the last few months as prices have rallied to historic highs. The one place where I think we are seeing more interest in hedging in precious metals is around M&A deals, where buyers are paying high valuation for the assets that they're acquiring and keen to put some kind of floor under future revenues.
Thank you. Pierre Chanel, moving on to the silver market is currently very, very tight. What have you been seeing in terms of physical flows that can potentially reflect this tightness? And could we see a change in those flows that could loosen the market?
Yeah, sure. As you said, so the silver market had tightened dramatically last year, but we actually finally see some easing on the forward side, with the main reason being the fact that the US decided not to impose tariff on critical minerals last week. So a lot of silver, just to remind you, had been shipped early last year from London to the US in anticipation of tariffs, which drained the liquidity in London. Silver was included in the Section 232 investigation after summer, the investigation on critical minerals. So this prevented metals to flow back from the US to London, and also with huge demand in India and Asia more generally during autumn, as well as strong demand since the start of the year from investors and ETFs, that led to a massive spike in lease rate in November. We discussed that in a few previous calls. The market remained tight until the start of the year, when we started finally to see more lending across the curve. During the first week of January, short dates like overnight, Tom Next were almost back to normal levels since early December. Big volumes were lent, but traders were just reluctant to lend more beyond those tenors, and they were just waiting for more clarity to feel comfortable to lend further out. But since the start of the year, swap rates from 3 months to 1 year shifted from -4.5% to -1%. The 1 month forward is now even trading positive. So a lot of metal is also being shipped back from New York. We saw, for example, over 4 million ounces withdrawn from COMEX on Friday. That's over 20 million ounces over the last 2 weeks. And I think that will continue as long as the arbitrage between New York and London is open, as long as the EFP is below the OTC level. So that's why we expect more metal to be shipped, probably at least around 100 million ounces or more out of New York. And the view is that lease rates will continue to come down and normalize So we've already gone from around 8%, 9% lease rate for 1 month to 1 year in December to now more around 5.5%. For 1 month, it's even below 4%. So now, of course, the market remains tight. The China premium remains near $9. Negative swap levels beyond 3 months is still far from a normal market for silver. But we've also observed some ETF outflows every week for the past 3 weeks, actually. And that should also help to ease the tightness, I think.
Thank you, Pierre-Chanel. We've talked a lot about capital markets now, and I think we'll focus with Adam now on more of the corporate side of things. First question for you, Adam, is obviously with such record high prices right now with gold, is it easier than ever to finance new gold mining projects? Are you guys being very generous with your clients, that is, Adam?
Well, not quite, Bernard, but thanks for having me. I think this is precisely the time in markets where everything looks good, so it's easy to get yourself into trouble, right? So even the more marginal assets that are producing are generating some quite stellar returns right now. And so it's actually incumbent on our colleagues that look at financing, especially with the Natixis balance sheet, these kind of operations to keep discipline and focus on the quality of assets through cycles, and also who's operating them. There are a lot of projects, there are a lot of good projects, but there are not as many really good seasoned operators. So that exuberance, is something to, in my 20 years banking this business, is something that's important to watch out for. You are right, though. I think especially with energy prices lower, a lot of a big input cost for the miners being fuel, the margins are absolutely looking generationally very, very strong. And, especially on gold, it appears that the downside risks to the price are more muted, the macro level. I think on silver, on copper, the view from our clients is perhaps these are closer to windfall type situations where companies are looking to more inclined to lock in hedges to really preserve those windfall cash flows and enable them to invest in their growth projects. I think what's interesting sometimes now is we've got a few of these polymetallic silver, lead, zinc assets, which were always looked at as base metals operations. With silver where it is, they're very much precious metals assets. So perhaps they're going to be out to their investors rebranding themselves as a silver company as opposed to a base metals company if these prices continue.
Interesting. Adam, in terms of price decks, any big revisions there, not just from banks, but maybe from equity brokers or so? Are we seeing much change there?
There's a lag effect for sure. And I think, the banks that lend as you would expect, a bit more conservative and slower to refresh their lending price decks, although they are done, every 6 months or so. So fully expect to see upward revisions to those on the lending side. I think an interesting dynamic in terms of the commodity analysts setting the outlook, such as yourself, for where the price is going, and then how those prices factor into the mining equity analysts and their models that they use to put a valuation and net asset value on a company's portfolio of assets. So, we've run up so far in the last 6 or 7 months across gold and copper and PGMs that I actually don't think we've necessarily seen the denominator of that price to net asset value. The denominator's not necessarily been fully refreshed to take into consideration those higher prices. So I would fully anticipate that the multiples that you see, so the PNAV, may actually start to go down as the equity analysts increase the NAV for those higher prices. So you might start to see more momentum in the equities themselves for mining. Thank you,
Adam. Just the last question for you. You were talking about the rebranding into silver companies, some of the mining companies into silver companies. Are we still seeing a lot of appetite from gold majors to acquire copper assets? It was part of the conversation last year for the past couple of years. And is the case still sensible?
We are still seeing that. at the moment, at least, copper has kept pace with gold in terms of the continued price momentum, and gold mining stockholders do still seem comfortable with some diversification of the gold miners into copper or copper gold assets. So it's a trend that continues. One thing that is very apparent is that when prices have run up so quickly, there's an increasing quantity of equity consideration as opposed to cash consideration. So there's a few examples where we were following precious metals assets that were potentially going to be bought for cash by private equity groups, and ultimately they were outbid by other publicly listed companies that used their equity currency, which had also appreciated. So the value of the deal, while not cash, was much higher in terms of the shareholders exchanging their mining shares for shares of another mining company. So I think we'll see more of that activity, gold into copper. I also think we'll see more equity consideration at these levels.
Thanks a lot, Adam. Thanks a lot, everybody. This concludes our precious metals session. Thank you.
So this brings us to the end of our sessions on individual commodity markets. Thank you very much for your attention through what's been a very interesting set of discussions. So how do we summarize the headline views from our experts on commodity markets for 2026? Well, really Trump is at the center of everything and really pushing us away from what we call traditional fundamentals, driving heightened geopolitical risk, pushing tariffs, which causing trade dislocations across several commodities, and then threatening Fed independence, which of course has significant influence on the precious metals complex. So really beyond your traditional supply and demand balance, it might be better to be tracking Trump's Truth Social account to get a better handle of the dynamics at play this year. So to summarize, Bernard, what would you say is your kind of key takeaway on the key markets for 2026 on the metals complex?
Yeah, on the metals complex, I think from what I heard from pretty much the agreement is basically the role of CTAs, money managers, or speculative money is more important than ever and weighs much more probably than it ever has for the base metals complex. I think that carries massive risks. I think a lot of it is being driven by some people trying to use the commodity base metals market as a proxy for the AI revolution, for the energy transition revolution. So there's a lot of speculation going there, which carries its risks. And that goes from the big metals like copper to the much nicher metals like uranium. As you were mentioning, there's like some funds right now with around holding $4 billion worth of uranium, which is not small. I mean, the second point also to mention is that if for base metals and even for precious metals, the American tariff story was a big source of price rally in 2025, probably think that for 2026, we will have reached, it will remain a big story, but we will have reached peak tariff rates. And that probably puts a cap on how high base metals reach. And also if we've reached probably the peak, then we could also talk potentially about lower rates perhaps. And we're not standing on strong fundamental demand and consumption. The final point to make is more on gold. It seems there is more divergence of views between myself, let's say, on consolidation, some of the other views which talk about a continuation in the rally, although not at the same levels that we saw in 2025. And how about you, Joel, in terms of energy?
Yeah, so I think for energy, the point that you made on base metals, particularly copper, but the divergence between narrative and reality is particularly relevant. So for oil, for example, we've had this oversupply narrative for the second half of 25 and Q1 26. Really hasn't yet to be reflected in flat price levels and market structure. We do believe in that oversupply, but we don't think it's going to be as strong as market consensus, and we do see a relatively solid floor for the market. We see the same dynamic for European gas. So the narrative of substantial reductions in prices for summer 26 based on the kind of LNG supply wave. That is something that we concur with here, but it is incredibly important that we do see these projects reaching the market to schedule. If we do see any slippage there, then that could have substantial implications on price formation both in Europe, Asia, and the US, given the feed gas demand is underpinning a lot of the more positive views on Henry Hub. And then for carbon as well, we do have this narrative that SECs have really taken on board speculative market players for a tightening EUA balance. And whilst we have seen prices approach 90 euros per tonne, I think one thing that was highlighted in our carbon session really was some of the vulnerability, the inherent vulnerability of that position, and therefore prices around about 90 euros, given the fact that ultimately speculators don't have that compliance obligation. So whilst we do believe in that tightening narrative, we don't think it's going to be a one-way bet, because ultimately we do need to see very strong compliance buying before we see sustainably higher price levels. So I think that sums up our key views on the commodity markets in 2026. Thank you to all of our experts for joining these sessions, and thank you most of all for tuning in to listen to our views and share with us this outlook for 2026.
Thank you. Thank you, everyone.